Hello, this is Kevin Stang with Deep Future Analytics, and I'd like to thank you for joining us today for our webinar, Comparing Results of CECL to FAS5. Today's presentation is a joint presentation by Prescient Models and Deep Future Analytics. And I'd like to begin by introducing today's presenter, Dr. Joseph Breeden, CEO of Prescient Models and also Deep Future Analytics. Now, I'm a little biased, but Joe is arguably the best-known name in the credit risk modeling industry. He literally wrote the book on loan modeling for the banking industry, as well as over 50 other trade publications in his name. His talents have been called upon across the world as he's created numerous financial models during numerous economic crises. Back home, he's been cited numerous times by the Fed Board, FASB, and other major publications, and in fact, he invented vintage modeling. So without further ado, take it away, Joe.
All right, thanks, Kevin. I know you're all on the call to hear the comparison between CECL and FAS5, but you can't compare without a model. And we wanted to use the best model we know how to make. So I know there are plenty of people on the call who know me and know the models, and this will be a brief review. I won't dwell too long, but I do want to give a little background on the model just to give perspective on what we've done. Basically, we tried to make the best CECL model we know how. And I should probably not be quite that shy. I think it's about the best model going. In any case, we're going to compare that both to a 12-month loss forecast for the same model so that you can see what a forward-looking view under a short horizon would look like, and also pull out data from FDIC and NCUA so that we can actually do a comparison between a CECL model and what lenders are currently reserving. So we're trying to be as direct in that comparison as we can be. So we, in using our model, which we call a multi-horizon survival model, it is a competing risks approach that looks at both charge-off and probability of payoff. For term loans, we forecast through the full life of the loan. We're taking into account early payoff. So a 30-year mortgage, we will forecast for 30 years, even though the average life may only be 6, 7, 8, depending on the portfolio. For lines of credit, there are many different ways one can do this, many different interpretations. We are using a best case analysis here, what some call FIFO. We think of it as implied term, where you take the current balance, look at the payment history, and see how long it would take to pay them down if they continue that, including some minimum payments and some other adjustments. For scenarios, you'll see the bulk of the analysis here run with a DFAST-based scenario for the first 24 months, and then with mean reversion on the environment that we use in the model to a long-run average. Now, in case anybody is disappointed at using a DFAST base, if you wait to the very end, you'll get to see what a severe scenario would look like in comparison. And the estimates are net of average recovery rates as well. So, as I mentioned, for FAS5, we're looking at the most recent loss reserve totals as put out by FDIC and NCUA. Those sources they have product level detail but not loss reserves. And the reason this matters is that lenders can also have Q factors, qualitative adjustment factors, under both the old rules and the new rules. So what lenders are actually reserving, according to FDIC and NCUA, is after any qualitative adjustments and accounting adjustments. What we have for CECL is a model-based number before that. So please keep that caveat in mind that even our own client base, it's all anonymous here, but these lenders themselves may come in and make a significant number of adjustments. And in fact, I think there's a fair amount of incentive to add adjustments to make the new results line up somewhat with the old. So you may say that the point of this presentation is to show how much work is going to be required to make the new estimates line up with the old estimates. So for the multi-horizon survival models, the key rates for modeling that we are looking at: a probability of default, a probability of attrition, which is account payoff, the exposure at default and the loss given default. These things, the first two, PD and I actually like to call it PA, probability of attrition. These are handled via our multi-horizon survival model. The exposure at default is using the payment allocation rules. Some of it can be modeled based on amortization schedules and such, but there's also this accounting aspect under the CECL rules about payment allocation. And then the eventual loss, and this is just, in these cases, it's a simple recovery rate. So the first thing we do in our modeling is we actually do start with a vintage model as a first stage analysis. I know many of you will have seen this graph before. This is a vintage graph of mortgage data. We use this because nobody minds us showing Fannie Mae, Freddie Mac mortgage performance. Each line here is one vintage, and if you pick a line like the red line that peaks in 2004 and then peaks again around 2010, that is the 2000 vintage, which went through 2 recessions and the normal maturing process for the loans. So it has a rather complex behavior there. Other vintages like the 2010, 11, 12, you can see much lower, significantly better credit quality. So there's a lot going on in this graph. We've got age of the account effects, we've got recession effects, and we've got credit quality shifts. So what we do is a vintage decomposition approach. It's called age period cohort modeling, and in fact we use a Bayesian version of that, which just gives you very high resolution estimations. It produces a life cycle versus age of the loan, a measure of the environment versus calendar date, and credit quality versus the vintage. So these are the outputs one would get by applying that model to the graph that I showed a moment ago. And what you can see here, it's been segmented by subprime, prime, and superprime as that top graph. You can see it rises fast and then flattens out. I should say that this analysis is a conditional PD. So for each age of the account, if I look at age 60, 5 years in, that's conditioned on the accounts that are still active at age 60. And so if I go down to the super prime, and if you said, well, why does the super prime graph rise in risk through the age of the loan? It's because the better loans have refinanced. There's a bias towards riskier loans being the ones who are on the book longer. So all of that gets captured in the life cycle, those age effects. The middle graph is measuring the environment. This is like a seismograph trace, measuring each month how much more or less default occurred than one would normally expect. And so what normally is expected is the life cycle. And on the environment graph, that's the 0 line. And then you see 2 recessions in here, the consequences of the 2001 recession and the consequences of the 2009 recession. You also see some spikes. There's a spike in here from 2006, which is the bankruptcy law change. If I look at this by state, you would even see the impact of hurricanes and power outages and other things. The graph on the right is measuring credit quality. This measure is showing me one number of credit risk for each vintage, and it's split by subprime, prime, super prime. It may seem surprising, but the subprime vintages are less dynamic through the credit cycle than the super prime vintages. Actually, you should note that the credit cycle is not the same as the economic cycle. The peak in the credit cycle in terms of poor credit quality was back around 2007, whereas the corresponding losses come in 2010, which are a combination of both the maturing of those risky vintages and the economic environment. My last talk, my last webinar was given discussing where we are in the credit cycle and the economic cycle. If you missed that, I talk at some length about this credit cycle effect, and the link is available. I recommend that you take a look at that. Next, we take that environmental function and create an economic model for it. So we look at commonly available variables, things you might find in the DFAS scenarios, because that's what we wanted to run here. We apply certain transformations of those so that we get good properties. Log ratio, for example, is a measure of roughly normally distributed. A better thing to use in a regression style model than actual percentage change would be. We actually, all of our methods there are documented. I should say a few more words about the economic modeling. We go through and optimize lags and windows and transformations across the different factors that we consider. There are different factors for different products. So if I'm looking at commercial real estate, it won't say house price index, it'll say commercial real estate index, and there'll be some other factors. So in fact, this set of factors listed here is for mortgage. Other products will have different appropriate factors for it. So we have a lot of that documented elsewhere if anybody is curious about how that works. In fact, the books that were listed with my bio, the one on Living with CECL, Mortgage Modeling Alternatives, goes through in quite a lot of detail about the economic modeling we do in the context of mortgage. The next step is behavior scoring. And this is where we're taking the APC model as inputs, where we know the age of the account, we know the environment that the accounts have lived through, and then we want to measure the account level credit risk. So we're trying to adjust for the fact that an account that defaults in a good economy like today is not the same as an account that defaulted in a bad economy like in 2010. And so when we're measuring credit risk and looking at the importance of different factors, we should be adjusting for that. We also have to look at how far in the future we're predicting, because one of our key findings in this multi-horizon survival model is that the value of information with time changes the further you look in the future. Delinquency is the most important predictor of default tomorrow because you're probably already delinquent today. But 12 months from now, if you're delinquent today, you must have cured to survive that long, and so other factors matter. So the information content and the decay of information is the main thing that we capture in a multi-horizon model that's not part of a standard survival model. This graph is showing, again in that mortgage context, based on the delinquency status at the end of history, your snapshot date, when is the account most likely to default in the future? And you can see that the higher the delinquency state today, the higher risk of default versus forecast horizon. And in fact, the dynamics here are really fascinating to analyze as you look across buckets and look at how the risk inverts the further in the future you go. What's fascinating is to compare that to other factors in our score, which is that things like LTV, debt to income, number of borrowers are not very important the first few months because we're dominated in our forecast by delinquency. But as you get out 5, 6 months and further, in fact, the coefficients are converging back to, not exactly, but closer to an origination model, because in the long run, delinquency is less important. Not unimportant, just less important. And so we get back to saying things like FICO and LTV, and these factors really do matter. And you'll find the same kind of pattern if I'm looking at commercial real estate and other cases. Forecast accuracy by horizon. I've also made presentations where I do this comparison, especially in the context of CECL. The point is that vintage and multi-horizon survival models are both good models to use. They both have long-range accuracy and stability if you get the economic scenario right. All of this analysis is independent of the economic scenario. The difference between a survival model and a vintage model is that the multi-horizon survival model is account level. So going to the account level is not about being more accurate, it's about having greater resolution into business practice to making it more actionable beyond CECL. So that's why we use that model. That's the quick summary of how that works. And then what do we get from it? Well, let's jump right in. I know that's why you're here. This is our first result. If we look at the ratio of the output of that model to what is currently being reserved under FAS5. So the x-axis here is that ratio. Now it does get to some very big numbers on here. It also has some very small numbers. The distribution of consequences here is really very broad. And we've segmented between community banks and credit unions. You can see right away comparing the blue bars and the red bars. And what this is saying is that among community banks, the most common result, the median outcome here, is a significant reduction under a CECL model compared to FAS5. Now, this is before Q factor adjustments. I would not be surprised if we see a lot of community banks adding Q factor adjustments to bring that more in line with their current loss reserve practice. There are a lot of valid reasons to do that. This is currently a base economic scenario. You could immediately say, well, I'm worried about a recession, especially in my market. You can naturally say that the CECL model only sees the things in the data it's given. If there are risks outside that data, then it's natural to include them as a qualitative adjustment. So this is not to say that this will be the final outcome of adopting CECL. It just says this is your starting point, comparing your CECL number to what you might currently be reserving under FAS5. So that's a 60% reduction for community banks. For credit unions, you can see this distribution is shifted to the right. In fact, the median answer is a 22% increase. I bet there's a lot fewer Q factor additions for credit unions. I know that it's difficult to have a negative adjustment with Q factors. That's often difficult to get approved by auditors and such. So I think it's fair to say that credit unions are likely to see some increase in loss reserves. Why we see the difference in community banks and credit unions? Well, it has to be partly about the products that they have on their books. And so then coming slides will break this down by product. I personally believe it's also partly about the regulatory environment, that credit unions being nonprofits are managed rather aggressively to keep costs down. So their current loss reserves are pretty close, I would guess, to their annual actual losses. Whereas community banks are, I believe, managed more to reduce risk than they are to manage their profitability, since they are allowed to be profitable. They're not nonprofits. So in reducing risk, the best way to reduce risk is to increase your loss reserves. So there can be very valid reasons why these different groups have different practices at present. But let's break this down by product so we can at least resolve how much of this is due to the products that we're looking at. So that product comparison, as I said, I have product level detail but not loss reserves. So the best we can do is take our same model and compare a 12-month horizon and a lifetime horizon. Basically, this is going to be looking at how many years of coverage you need under CECL compared to what you would have had before. And so let's look at auto loans. Now here I'm not splitting by community banks and credit unions because I'm not comparing to their FAS5 number. It shouldn't matter. This is just saying for auto loans, this is essentially telling me what the average life of the loan is across all these lenders. And so it's saying that that ratio, each bar here is another lender. So the percentage here is the percentage of lenders that we're looking at. And it's showing me that for auto loans, the most common is that 2 to 2.5 ratio. It's equivalent to saying that the average life of an auto loan is 2.35 years. You can see some portfolios have much longer lives. That would be longer term loans with less early payoff. Some are quite a bit shorter. I'm comparing that to consumer loans. Consumer loans tend to be shorter lived products. And so you can see here that the biggest bar is the 1.5 to 2 year bar. And of course, there's a lot of 1 year consumer loans out there, that sort of thing. So obviously the ratio for consumer loans is smaller. It would say that under CECL, we can expect an increase on average of 60% for consumer loans if you're currently reserving at a 12-month horizon, whereas for auto loans, it's well over 100% increase under CECL. Now for real estate, I'm showing HELOC and residential real estate, basically mortgages. And the red line for the red bars for mortgage, you can see there are differences. The median is 2.4. There are some short-term, these may be home equity loans as well as 15-year, 30-year mortgage blended together here. But looking across those, there are plenty of lenders out there whose average ratio is 5-year, 6-year, 7-year. Some of them, in fact, quite a bit larger than that. For HELOC, I need to explain. HELOC is quite a mystery under CECL because there is a law, and I wish I could remember the name of the act, which says that by act of Congress, a HELOC cannot be canceled unless you go through a certain process. However, we saw through the last recession that lenders can and do freeze the unused line. The amount of available credit line is at the discretion of the lender. So that means that it's not a cancelable product, but it is manageable. Now, FASB didn't make that distinction with the CECL rules. A product is either cancelable or it's not, and if it's not cancelable, you're supposed to consider future spend, although it's not exactly clear what future spend means. So this calculation for HELOC assumes the product is not cancelable, but that the future utilization can be capped so that there's no additional risk beyond current utilization. I'm hearing rumors that that may not be the auditor interpretation. I think a more legalistic interpretation, if you read the sentences word by word, you may conclude that a HELOC has to be managed more like a CNI line with a 10-year term. But in fact, HELOCs are worse than that, as you know, because there's a draw period of 10 years and then a repayment period, which can be 5 years or whatever. It's flexible. So this is the optimistic case for HELOC. It may be surprising to say that with a ratio here of 4.4, meaning a 340% increase of loss reserves. I think actually if we shift to doing a uncapped utilization approach for a 10-year draw period, that can go up significantly. So I think from a product perspective, HELOC may be our worst case example under CECL. Okay, agricultural loans, CNI loans, and commercial real estate. So the bars here are showing those different products, and you can see that this is really just capturing the average age of the products for these loans. In all of these cases, we're assuming that we look at the payment patterns and see how they would pay off with time. So across these different kinds of commercial type loans, the average lifetime is looking like it's 2 to 3 years. And with that, you're going to wind up with that kind of an increase under CECL. For consumer line and credit card, the big issue on both of these is the difference between transactors and revolvers, especially for credit card. So we have some credit card portfolios where the ratio is actually less than 1, that they are heavy on transactors. That's not the most as the average life of the line. So what that means is that the consumer line and credit cards may not see a significant change as you shift to CECL, depending on your mix of transactors and revolvers. Okay, ag line, CNI line, and CRE line. So again, looking at the credit line dynamics here as we go across these different products. So if I take all that together, where do I get? Let's look at our summary. I started with what the ratio is for credit unions and community banks, but they offer different products, and those products have different lifetimes. So I wanted to separate how much of what we're seeing is a difference between products and how much is a difference between the actual management of credit unions and community banks. So we built a model, and that model looked at what if we assume that FAS5 is a 12-month loss reserve, multiplied by the lifetime and years of and do this product by product for the products that are being offered by community banks, and then compare that to what we were estimating from our models. And what you come up with is that CECL would be about 12% of the FAS5. So why did I get a 40%? I said 60% reduction, so it would be equivalent to saying 40%. I started with 40%, now I'm saying 12%. Well, it's because you're multiplying by the lifetime of those loans, which on average is greater than 1. So it's saying that intrinsically under FAS5, community banks are reserving quite a bit more than what a CECL model would say. Now, it's not a bad model. In fact, we've done a lot of tests. I will argue this is a very good model. It's just saying that a model-based result is different from what people are doing right now with FAS5. And so the difference between CECL and FAS5 is going to be all about the qualitative adjustments. For credit unions, if you consider the same thing, look at the life of the loan in years times what's currently being reserved, you'd get about a 45%. So it's, if CECL was a one-year horizon, it would actually result in a reduction. So it's equivalent to saying that about half of the loss reserves out there for credit unions are Q factor based as well. So, but of course CECL does include the life of loans. So if you look at this differently, the 12% and 45%, that is the intrinsic difference between a credit union and a community bank. Credit unions, if I could normalize for the product and the models and everything else, credit unions are reserving about 3 times what a community bank does. No, it's the other way around, I'm sorry. Community banks are reserving about 3 times what a credit union does for the same product, the end result here. Now, I'm just putting a summary out here. There's another easier way to look at it, I'm sure. What is the current years of reserves under FAS5 that community banks have and credit unions? So this is literally looking at the historic data, and we see this by individual institutions. There are individual community bank institutions whose current loss reserves under FAS5 are equivalent to a backward-looking cumulative losses of as much as 8 years. For credit unions, that's more like 2 years. Needed years of reserves under CECL, how many years does CECL say you need? Community banks would really need about 3 years, and credit unions would really need about 2.5. So this is where those reductions would come from if you just adopted CECL exactly as a model would say before the Q factors. And here's my last result. What about a recession? Because we've talked a lot about the possibility of recession. Short answer is, for community banks, if you're worried about safety and soundness under a 60% reduction, simple answer is assume there's a recession, because that would flip this around to saying you need a 70% increase. Now that's the severe recession scenario under the DFAST. If we assume it's more like a 2001 scenario, you're going to wind up about halfway in between. Immediately your loss reserves are not really going to budge from today. For credit unions, that 22% increase goes to about 100% increase. And again, a 2001 style recession, which I personally think is a lot more likely than an 09 recession, you might wind up with a 50 or 60% increase, not 100%. So